Good afternoon, everyone, and welcome to today's presentation. My name is Michael Corgiat. I'm one of the Retirement and Focused Advisors here at the Retirement Group. Welcome. These on-demand webinars are just one of the many resources that we offer. Today's presentation, we're just going to discuss some of the commonly asked questions that we get during many of our presentations, but we offer a number of other resources that I think you'll find helpful. We have retirement guides created for all the employers that we do work with. So all you have to do is reach out to our office and we can email you the retirement guide that is specific to your company. We also have a great ebooks library filled with books on all sorts of different subjects. Things like Social Security, or Medicare, estate planning, tax planning, insurance planning, just to name a few. We also have a newsletter and a blog. You can find a lot of this information on our website, theretirementgroup.com, on our LinkedIn page as well. And we also have a YouTube page where we keep a lot of these recordings as well. And then finally, probably one of the best resources that we offer is our retirement cash flow analysis. We call it our Retire Kit. It's a comprehensive snapshot of what your current situation looks like and what your retirement can look like, especially if it's soon or even later. The sooner that you start planning, the better off that you're going to be long term. I've always found, and statistics show, that individuals who start planning for their retirement at least 5 years prior to their retirement are going to be better off than those folks who waited until, oh my goodness, I've just been laid off, or I've been given a severance opportunity and I'm going to leave. So the sooner the better you're going to be. We are a team of advisors. I'm just one with a great deal of experience. We're very knowledgeable on your company benefit programs, specifically your pensions, your 401ks, and your medical programs. We've got offices nationwide. I'm here in the Midwest. I've got clients all over the country, and I've got colleagues all over the country. So just reach out, and I'm sure there's an advisor close by. And I mentioned already, but do take advantage of the complimentary financial analysis that we'd be happy to put together for you. We'd look forward to putting it together and helping you out. So let's dive into some of these popular questions. The first one, I've learned from my employer that my pension won't keep pace with inflation. What can a nearly retired fellow like me do about this? That's a great question. Most publicly traded company pension plans won't keep pace with inflation because they don't have a cost of living benefit built into them. So your monthly benefit when you start it is going to remain at that level throughout your lifetime. There's no COLA. Many of those same employers that we work with also offer other pension forms that you can take, and the one that I want to talk about is lump sums. Many employers offer a lump sum option in lieu of taking a monthly pension. Taking that lump sum puts the onus of your own retirement on your back and takes it off the employer. Now you're responsible for your pension when you take the lump sum and smartly roll it over into an IRA and then create your own monthly income. There's many ways that you can do that, but a moderately allocated investment portfolio with equities and fixed income can definitely over time provide you the option for your monthly pension, your monthly income, to grow as you get older. And you could also possibly take a portion of or all of that lump sum and invest in your own personal annuity. If you want some sorts of guarantees, those guarantees are available with personal annuities with some of the various insurance companies that we work with. And those annuities are going to and can provide you with increases over time depending on the overall investment formula that's available to you. The more aggressive, hey, the more opportunities. We prefer more conservative investment approaches, and I'll talk more about that here in a moment. But these options are available to you, and you can alleviate this problem with inflation. So keep all that in mind. But finally, I also want to mention that what you do for yourself in the form of contributing to a 401k, getting that employer match, doing IRAs, Roth IRAs, regular IRAs, or just savings in general, your own brokerage account, money in the bank, CDs, whatever it might be. What you do for yourself will also do a couple of things. It will provide you with a more exceptional retirement than just your pension, because your pension really is only geared towards, if at best, replacing one of your 2 monthly checks if you were paid twice a month. What you do for yourself will give you that other check. It could be a great check. So again, the more that you do for yourself in personal savings, the better off you will be in retirement as well. Next question. I've heard a lot about recessions messing with people's 401ks. Being on the brink of retirement, are there any funds that could spell trouble for me? It's a great question. There's a lot of talk about recession right now. We've been through some very difficult times the past 3.5 years since COVID. It messed with all of our lives. Government stimulus, federal monetary stimulus created a lot of inflation. And we're going to talk a little more about that. But it also created a lot of spending, which created that inflation. And now inflation got out of hand. Last year in the summer, inflation peaked at over 9%. The Federal Reserve has raised interest rates and raised them aggressively. Part of the what happens with those raising interest rates is the Fed's intention is to slow the economy down, to slow down spending. That slowing of spending will lower inflation, but it can cause a recession. Businesses produce less, people buy less services and goods, and boom, we could go into a recession. I don't know if we're in one now. I don't think so, but there is a good chance that our economy and our country will go into some sort of mild recession later this year or early next year. As far as investments or funds, let's talk a bit about that. There are essentially growth funds and there are value funds. Growth stocks are very aggressive. They're very volatile. They go up and down a lot more than value or more conservative oriented investments. Last year, growth stocks were down 30%. The S&P 500, which is a blend of growth and value, was down less than 20%. Value stocks were down between 5 and 10%. Much less volatility. So, investing in more conservative equities can help you. Taking advantage of these more conservative equities in your 401k does a couple of things. It limits the liability, it limits the volatility of your overall, basically the ups and downs. You will see appreciation in value-oriented investments, and you get paid dividends in many of these investments as well. We here at the Retirement Group are more value-oriented. We believe in more conservative equity portfolios to level out the volatility throughout your retirement, which could be 20, 25, or 30 years. So look for the more conservative funds, maybe the asset allocation funds that are available to you, and just reach out to the office. One of us would be happy to talk to you about what's available in your 401k and what might make the most sense for you. Our interest rates. Interest rates are all over the place, and yes, they are. I am 60. I'm on the cusp of retirement. Do you think I might fare better waiting until next year? Okay. Well, I believe this individual probably works for a company that offers a lump sum pension option in addition or in lieu of a monthly pension. Lump sums are definitely impacted by interest rates. If interest rates are higher, lump sums are lower. When interest rates are lower, lump sums are larger. From last year to this year, interest rates have jumped significantly. And lump sums this year compared to last year, in many cases are 20, 25, 30, and maybe 35% lower this year than they were last year. So, would you fare better by waiting until next year? The answer is maybe. Interest rates are probably going to be higher. They're probably going to be higher for longer. I can't tell you where they're going to go in 2024 or 2025. Chances are they will moderate and eventually come down. And when they do, lump sums will go up. We'll know more about next year's rates in the fourth quarter of this year. We can also help you run pension estimates using hypothetical lower interest rates. All you have to do is ask. We'd be happy to work with you on that as well. But bottom line, chances are, if this is an option that you have, that it will definitely benefit you if you have that opportunity to wait at least a year and possibly two if you're considering retirement and you're considering taking a lump sum. Okay, great question. With healthcare costs climbing higher every year, I'm getting a bit anxious. I would be too. Am I going to be able to afford these bills when I retire? Okay, it's a few things I want to talk about here. Healthcare costs in general for a couple that retire at age 65. The total cost does go up every year, and over a life expectancy right now for that couple, it can average close to $350,000. That's premiums and out-of-pockets. That's a lot of money. You need to prepare for that. And the best way to prepare for that is to save to help cover those out-of-pocket expenses. As far as insurance costs, pre and post 65, okay? If you retire at 55 or 60, you're going to need health insurance. Many of your employers offer a plan that you may qualify for. Some of them offer those plans at a subsidized rate to you, so they pay a portion, you pay a portion. That's great. That lowers your out-of-pocket monthly premium expenses. But many of those same employers are eliminating these plans, and they're getting rid of the subsidies. So they might offer a plan, but you have to pay 100% of the cost. And premiums aren't cheap. For a couple going into retirement before age 65, those premiums could average between $1,500 and $2,500 a month. A month. And that's just the premiums. That's not the deductibles, the co-insurance, and the co-payments for your doctor's visits and your prescription drugs. So that might push you towards retiring later. Once you reach the age of 65, you're eligible for Medicare. Medicare is less expensive. It's the government insurance program. It's not the greatest insurance program, but it is insurance. Monthly premiums for Medicare right now are about $165 a month. They do go up, but that's the rate for this year. Be twice that for a married couple. You can get coverage that will supplement and or replace Medicare, and what Medicare doesn't cover, it's called Medicare Supplemental Insurance or Medicare Advantage insurance policies. Those premiums could be anywhere from, let's say, $100 to $250 a month, depending on the benefits that you sign up for. And those are available from a number of different insurance companies. Bottom line, you're going to have out-of-pocket costs. Your premiums outlays are going to go down, but you're still going to have expenses. And one final thing I want to bring up is HSAs, healthcare savings accounts. I'm a huge fan of them. Many of your employers offer these programs. It's called a healthcare IRA. You could contribute up to $7,000 a year for a married couple. You get a tax deduction. It's a pre-tax contribution like you do in your 401k. The money grows tax deferred and essentially is tax free if you use the money to pay for out-of-pocket healthcare costs. The healthcare IRA, I'm a huge fan. I have one myself. I suggest to everyone that I talk to and work with that they contribute to it, especially if their employer offers one. And many of your employers offer one and they give you a little incentive by providing some of their own money if you contribute to it as well. So definitely jump on those programs. I hope that has helped answer that question as well. If you have additional questions or would like to schedule a meeting, you can scan this QR code and schedule a meeting with myself or one of my colleagues here at the Retirement Group. You can also call our office at 1-800-900-5867 and ask any questions, request your own retirement guide, say, hey, I'd like to have a cash flow analysis put together. We'd look forward to helping you and talking with you. You can also send us an email at info@theretirementgroup.com if you don't like making phone calls, and just tell us what's on your mind. I appreciate your time and your attention today, and I certainly hope this was helpful. We do these sessions on a regular basis, so thank you, and come join us again sometime soon. Have a great day, and take care.